We are here today to launch the Central Bank's quarterly bulletin for the first quarter of 2015. I'll just introduce the people here. Sitting beside me is Gillian Phelan, who is the head of the Monetary Policy Division. On the other side we have John Flynn, who is head of the Irish Economic Affairs Division. And I am Gabriel Fagan, Chief Economist of the Central Bank. We will proceed as follows. We would like to start with a short presentation of a few slides, and then we will open the floor for questions and hopefully answers. So maybe we would start with Gillian on the international outlook.
Okay, thanks, Gabriel.
Sorry, okay.
Okay, so as Gabriel said, as usual, I'll just start with a brief introduction to developments in the international environment. So just firstly to summarise some of the key trends. The final quarter produced some relatively disappointing hard and soft data as the global economy decelerated. The support to growth from emerging market economies is now considerably weaker than it was during the financial crisis, and this reflects weak external demand and some policy tightening. Meanwhile, the recovery in the US and the UK remains on track, but the euro area continues to exhibit few signals to suggest that its lacklustre recovery will gain any real momentum. The sharp decline in oil prices, which began in June, has accelerated over the final quarter and has contributed towards a very subdued inflation environment in advanced economies, with the euro area's headline rate becoming negative for the first time since 2009. Inflation expectations also fell over the final quarter, with several euro area indicators of expectations reaching historical lows. With the intention of restoring inflation to its target of close to below 2% in the medium term, the ECB has announced at its first Governing Council of 2015 that it would be expanding its existing asset purchase programme to include public sector assets. So just to start by looking at the latest data on growth in some of the advanced economies. The euro area has expanded by just 0.2% in the third quarter of 2014, and that's up marginally from 0.1% in the second quarter. Growth continues to be reliant on consumer spending, which recorded its biggest quarterly gain since 2010. The increase in consumption, coupled with a modest increase in government spending, offset another fall in investment, and that was most notably in Germany. In the US, the latest estimate of third quarter growth is 1.2%, with activity being supported by improving labour and housing markets, as well as accommodative monetary policy. The unemployment rate has fallen to 5.6% in December, resulting in a decline of some 1.4 percentage points over the course of 2014. Survey data suggests that the growth will remain firmly in expansionary territory over the final quarter, albeit at a more moderate pace. So finally, looking at the UK, they released their first estimate of final quarter growth last Tuesday, and the estimate shows that quarter-on-quarter growth of 0.5%, and that's a deceleration of 0.75% in the third quarter. So oil prices have continued their sharp decline in the final quarter of 2014. Prices have fallen by 40% in US dollar terms over the final 3 months of the year, and prices have continued to fall since year-end, falling below $50 a barrel. The market remains in contango, with future prices trading above the spot price. In the chart on the right-hand side, we can see that the decline in oil prices has contributed to a fall in headline inflation rate in the euro area. The headline rate has turned negative in December at minus 0.2%, and the HICP rate excluding energy remains at 0.6%. Now this is the lowest level that core inflation, well, it's the joint lowest level measure of core inflation that has been recorded. Both hard and soft data continue to indicate limited price pressures, while financial market measures of inflation expectations have also declined in the final quarter of 2014. So to address the threat of a prolonged period of low inflation, the ECB has announced an expanded asset purchase programme at its first meeting of Governing Council in 2015, so that was about 10 days ago now. The target is to produce a combined total of 60 billion, or is to purchase a combined total of 60 billion of public and private sector assets per month. The programme will encompass asset-backed securities purchase programme and the covered bonds purchase programme, which were both launched late last year. Additionally, purchases will now include bonds issued by euro area central governments, agencies and European institutions in the secondary market. And the intention is that this level of purchases will continue until at least September 2016, and will in any case continue until we see sustained adjustment in the path of inflation, which is consistent with the aim of achieving inflation rates below but close to 2% over the medium term. In terms of the operational details, many of the modalities are still unclear, but we know that it will be implemented on a decentralised basis via national central banks in line with standard monetary policy operations. It's intended that the assets will be purchased with a remaining maturity of between 2 and 30 years, and taking into account existing holdings, NCBs within the euro area will be limited to holdings of less than 33% of any one issuer's bond in that maturity horizon. And finally, the anticipation of the announcement and the actual announcement of the expanded asset purchase programme has impacted on financial markets. On foreign exchange markets, the euro has depreciated sharply against the US dollar during the final quarter, falling by 4.3%. Reaction to the details of the programme contributed to further weakening of the euro, with the effective nominal exchange rate falling by 5.1% since the start of January. On the equities market, the ECB announcement has been the key driver, with the Dow Jones Euro Stocks Index rising by 7.5% since the year end. So on that, I'll pass you back over to John, who'll take you through the outlook for the domestic economy.
Okay, that's great, John.
Thanks, Kieran. Thanks very much, Gillian. Yep. Sorry, we're on the right side. So the main message from the bank's new forecasts is that the recovery in the Irish economy continues to broaden and to gain momentum. While exports were the main driver of growth in 2014, domestic demand contributed positively to growth for the first time since the downturn. So for the first time last year, we saw a positive contribution from domestic demand for the first time in a long time. It now looks like the economy has grown by just over 5% in 2014, and that's about half percentage points higher than we thought at the time we did our last forecasts some months ago. Now, as I said, the main driver of growth in 2014 was and the main reason for the upward revision to the forecast, to our number for 2014, has been the exceptionally strong export performance. And we noted this at the time of our last projections as well. There are some unusual patterns here because exports typically tend to grow much in line with demand in trading partner countries. But last year, Irish exports grew much faster than demand in trading partner countries. And this was mainly as a result of strong growth in contract manufacturing. And contract manufacturing occurs where an Irish resident firm contracts a manufacturer abroad to produce a good for supply to a third country. And it seems that changes in the structure of some multinational enterprises here in 2014 led to a change in the size of this activity in 2014. Now, unless that's repeated in the future, then it's probable that what we saw in 2014 is a one-off, but there's some uncertainty about that, so we can't be certain about this yet. What it does suggest is that the underlying strength of the economy is less than signalled by the GDP growth of 5%. So that would seem to be the case. Whatever about the export picture, though, the significant development, I suppose, over the last year has been the improvement on the domestic side of the economy, and that's now becoming consistent. Investment, which has been growing for some time now, looks to have grown very strongly last year, and there's been a resumption of growth in consumer spending, and that's been helped particularly by continuing growth in employment, which we've seen grow for a number of years now. So just to look at and say a little bit about our numbers. So if we look at 2015 first, our forecast for the economy for 2015 is for GDP to grow by 3.7% this year, which is 0.3% higher than our last published forecast. Now, the main reason for the upward revision to the 2015 GDP forecast as compared to the last time comes from an improvement in the outlook for domestic demand, with slightly stronger growth now forecast for consumer spending and investment spending this year compared to our last set of forecasts. An improving labour market and rising real disposable income should lend greater support to consumer spending this year. And if we look at investment, while we think it will slow a little from the recent rapid growth that we've seen in recent years, it's still forecast to grow pretty strongly this year. And in doing so, it will help to bring the share of investment spending in GDP, which had fallen to relatively low levels during the downturn. It will help to bring that back towards its long-term average. Now, as I said, while the growth of contracted production in 2014 complicates the task of forecasting exports, looking ahead, we're making our projections on the basis that exports will grow in kind of the traditional way, will grow in line with demand in trading partner countries, so that they grow in line with projected external demand for Irish exports. Now, we're helped by the fact that Ireland's trade is pretty diversified, so we have links with more strongly growing economies like the US and the UK, and that should mean that we'll continue to generate reasonably strong growth in exports. Now, overall, while export growth is projected to remain strong this year, in terms of net contribution, it's going to be the domestic side, which is going to be making a stronger contribution to growth this year. And the slightly stronger forecast that we have for consumption investment this time imply that we now expect domestic demand to grow by around 3% or so in 2015. While the recovery has broadened and gained momentum, if we look at inflation developments have remained relatively subdued, and the significant fall in the price of oil has had a dampening influence there. Now, on the basis of prevailing futures prices for oil, headline inflation is projected to remain very subdued this year, so we don't see much around by way of inflation. If we sort of look or assess risks to the forecast, we kind of judge them to be balanced. There's some possible upside potential, say, from things like domestic factors or from oil prices and the exchange rate onto activity, but they're offset by some potential downside in terms of the external outlook, because obviously there are risks around that. And future inflation developments obviously could be affected by movements in oil prices as well. So that's something to keep in mind. Turning to then just say a little bit about 2016. So in this bulletin we take our first look at prospects for 2016, and our view at the moment is that the outlook for 2016 is pretty similar to 2015, with GDP growth at 3.8% forecast for next year. Growth in 2016, in much the same way as this year, we see it as being supported by the better performance of the domestic economy. And again, consumer spending and investment are forecast to grow kind of reasonably solidly next year, against the background of continued growth in employment and some further improvement in incomes. And export growth is also projected to remain relatively solid next year. Now, we should emphasise, I suppose, that a good deal of uncertainty attaches to these projections, and so that would be a caveat there. Futures prices for oil suggest that oil prices will recover as we move into next year, and on that basis then headline inflation is forecast to rise again on the basis of the information that we have now. But I mean, again, we have to see what happens to oil prices. Finally, I'd say just a little bit about the labour market before handing over to Gabriel. So this slide looks at the labour market in more detail. The recovery in the labour market has been going on for just over a couple of years now, and after very strong growth in employment in 2013, employment growth was more moderate last year, although we still will project a year-on-year growth in employment of around 1.6% for 2014 as a whole. Now, in much the same way as the recovery has broadened, the overall economic recovery has broadened, the employment recovery has broadened as well across a broader range of sectors in the economy. And encouraging as well, full-time employment has continued to grow, and that's supported earnings growth. So we've seen kind of more full-time employment, less reliance on part-time employment. And we've also seen a fall in the number of long-term unemployed. Now, looking ahead, kind of with the current trends in labour developments reasonably favourable, and with an improved outlook for domestic demand, we now forecast annual employment growth for this year and next of kind of averaging about 2% per year, with labour force growth averaging about, say, 0.75%, 0.8. The net effect should be to see a decline in the unemployment rate, And if we look at, say, average rates for the year, we would be looking at an average rate of unemployment for this year of about 10.4%, and for next year about 9.3%. But end-year rates in both cases obviously would be lower, so they would be sort of yearly averages. So that is the sort of broad outlook for what comes from the new forecast. So I'll hand back to Gabriel now.
Okay, just have to check. Okay, I'm just going to have 2 slides on the broad policy messages which are contained in the bulletin. And if I were to summarize in a few sentences what those messages are, I think we're trying to get across 2 points. One is it's essential to build on and consolidate the achievements that have been made so far in a number of areas. And the second thing is it's essential to build up resilience of the economy so that it's in a position to deal with shocks should they emerge. Now, starting first of all with the fiscal situation, the public finances have seen a very significant improvement, benefiting partly, of course, from strong economic growth. It's likely that the 2014 deficit will be below 4% of GDP. But at the same time, the debt ratio at around 110% of GDP is very elevated, and that is a fragility of the economy. Now, with the current prospect for the deficit in 2015, it looks like the economy will exit from the excessive deficit procedure in due course. But on the other hand, we're still subject to a range of other European rules, including the preventive arm of the Stability and Growth Pact and of the Fiscal Compact. And what that implies is that we have a medium-term objective of a balanced budget in structural terms. And of course, the current the deficit now and the projected deficit in 2015 is still above that medium-term objective. So there is a need for further fiscal consolidation in the years ahead. In terms of the particular rules, it would be a fiscal consolidation in structural terms amounting to at least 0.5% of GDP per year. So this fiscal consolidation is needed. We're not out of the woods yet in that sense. We would also urge that in the event that there are more favourable developments in terms of revenue or lower expenditure than expected, that these gains would be used to reduce the deficit and bring the public finances into a position of greater certainty, thereby enhancing the resilience of the public finances. On the banking sector, there have been quite considerable progress in repairing the household and the bank balance sheets and firm balance sheets as well. We can look at a whole range of indicators. On the household sector, we see an increase in household net wealth, reduction in the overall level of debt by households, a reduction in the debt to disposable income ratio, a decline in the number of households in negative equity. So on the household side, there are clear signs of improvement in balance sheet positions. In the corporate sector, our latest SME Market Report highlights a number of improvements that have taken place in terms of financing conditions and the financial state of the SME sector. So there too we see improvements. And of course, in the banking sector, we have seen quite significant improvements in terms. First of all, we have seen the domestic banks return to profitability after a long period of very significant losses. This being driven by a decline in impairments and also an improvement in the net interest margin. We have had the comprehensive assessment, which overall the banking system performed very well in. We are seeing progress, for example, in addressing arrears by mortgage arrears. That is very clear. So there are clear progress there, but at the same time, it's now time to start looking ahead and see what can we do to ensure that this resilience is enhanced and strengthened. And in this regard, the measures that were announced last week by the central bank to impose proportionate limits on residential mortgage lending are an important step, we think, in trying to generate that resilience and guard against future risks. But it has to be stressed that these macroprudential measures are not a substitute for the bank's own lending policies. The banks are expected to exercise due diligence and to evaluate credit in a rigorous manner rather than just relying on the headline numbers that have been provided in the macroprudential regulation. Now, we have 2 additional signed articles in the quarterly bulletin on the HFCS and on the macroprudential measures, not our ones, but a review of macroprudential measures. So the authors of these 2 articles are in the room, so should you have any questions, they would be willing to take them. And John will briefly bring you through the overall headline of the articles.
I can say a little bit about them. The first article, and I'd give a big plug to this because it's based on a new data source for the economy, which is very interesting and it's got huge amounts of interesting data in it. It's based on the Household Finance and Consumption Survey, which the bank has been involved with CSO in setting up for Ireland. We have lots of data which looks at sort of flows in the economy, so income and other flows, but not a huge amount of data on stocks in relation to households, say for example the asset and liability positions of households. And this survey focuses and looks at not only just income but also kind of wealth and debt distributions across households, across age bands and across income groupings. The survey was carried out by the CSO from March to September 2013 and was just published last week, and we've published an article kind of taking a first look at what's in the survey and what are the interesting things from it. And it looks at sort of how Irish households compare to Euro area households. It has a lot of data in there on the asset and the debt positions of Irish households. And what we see in general is that, say if we compare to Euro area households, Irish households tend to be larger. We tend to have higher home ownership rates. Irish households tend to be younger. But what's most interesting is if we look at, say, the debt and wealth position of households. And what it tends to show is that things very much follow a kind of a life cycle pattern, with debt being built up kind of in the early ages. The survey tells a lot about where, and the article tells a lot about kind of where the debt is concentrated in terms of age cohorts, in terms of income groupings, and also then the asset accumulation as well. So there's a lot of very interesting information in there, and I'd encourage you certainly to go have a look at that. And we have the authors here to take any questions on it as well. The second article then looks at the instruments of macroprudential policy. And again, a fairly topical issue. Macroprudential policy is a relatively new remit, I suppose, in Europe, and we've seen how the crisis has highlighted the need for the development of macroprudential tools. This article looks at the aims and considerations and some of the cross-country experiences, and so again, I would urge you to have a look at that. Again, we have the authors here if you have any questions that you want to follow up on that, so that would be...
Okay, thank you very much, John.